Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, April 19th, 2024. S&P 500 currently below 5,000, sitting at 49.78, about 5%, a little more than 5% off the highs. I'm David Zarling. I'm here with a lover of quiche for breakfast, Ian McMillan. I don't know that that's true, though.
It's not.
We're off the highs, but I don't think you like quiche.
One of those statements is true. What's that game? Wasn't there like a game on TV back in the day?
Oh, yeah. Yep.
People would tell like 3 truths and a lie, and you had to guess.
Yep.
2 truths and a lie. I don't know. But yeah, stocks, took out the 50-day moving average pretty swiftly on Monday morning, and it has been a continued downslide.
Yeah, we are 5.5% using the S&P off of the all-time highs. If we use the Nasdaq, right, a leader, if you will, we're about 7% off the highs.
Yeah,
and
Nasdaq
IWM
definitely having the worst go of it this week.
And IWM, this is a little bit of a trick, but it's still 21% off the highs.
And Dow, so I'm looking at, 5 days. Dow's down like 27 bips, and the Nasdaq's down 5% this week. So interesting.
If I can walk through this was put out by Bespoke Invest. So S&P, like you mentioned, is about 5.5% off its what we would call its 52-week high, right? Its most recent high. The average stock in the index is 14% below its 52-week high. And when we look at sectors underneath the surface, and this is where it gets a little bit nuanced because we just recorded an all-time high in the S&P and Nasdaq just last month. But then you look at something like IWM or small caps that are still 20% off the highs. That goes back to 2021. And so that some of these sectors that I'm going to go through, it's all within context. Some of them, the correction is from the most recent all-time high back in March. And some of it is they're still below 2021 highs or 2022 highs. So, for example, consumer staples still 18% off its 52-week high, which is obviously 2021 is further than 52 weeks ago, but some of these are even further from an all-time high perspective. Technology is 14% below a 52-week high. Financials 9.9% off a 52-week high, but financials were trying hold all-time highs and they didn't from last month. We're below that level using something like XLF. So corrective behavior in the market, no doubt. Is it the end of the bull market?
Yeah, I think that's tough at this stage. There's a lot of stuff I'm disappointed in.
Quiche being one of them.
Russell never held, like we're back in this range. RSP, equal weight, not holding its 2021 highs, so failed breakdown there. Now we're getting to the point where, this is 6 red days in a row for the S&P, which is pretty rare. I think Bespoke even I was shocked by this. Bespoke said yesterday that the S&P averages two streaks a year of at least 5 down days in a row. So I'm willing to bet that, and it was 40 times in the last 20 years. Obviously 2 times a year. Like most things that we look at in averages, I'm absolutely willing to bet those are clustered together because that is pretty rare. And really, even after 3 red days in a row, that's some long red candles over the last 2 weeks. Even going back to the bullish or bearish engulfing on early April on the 4th, you would think of, some type of short. And intraday, we've gotten some bounces for sure, but they are quickly sold.
It's a pretty controlled discounting is what you're saying. Like the price movement to the downside has been steady.
Yeah. And of course, VIX has moved, right? VIX has gone from 12 to 21, but not that it can't start here.
We had a move from November of 2023 through March that was in the top 1% of moves in a 6-month period. So would cooling surprise us? Now it's a matter of, is this just standard fare? Which I think is your point. Is this just a standard, right? For example, we typically get 3.5%, 5%, negative 5% counter trend moves in a year, 10% correction per year. That's pretty standard. The question is now, does it become more? We only know that with time, but
I'll throw Apple on the charts I'm disappointed in. That's going to be a headwind. It's really fun on the way up. It's so fun on the way up. And it's going to be equally as not fun on the way down. Or if this goes think as of Wednesday or yesterday, XLK is now below its relative 200-day moving average. For context, it's not the worst looking relative chart. I mean, it's tech is tech, but there's continued to be signs of things popping up. We lost Netflix today. So the magnificent stocks, I mean, I would say outside of Google and I guess maybe Amazon.
Well, even Meta. Amazon. I mean, yeah, I was going to say Meta and NVIDIA, if you're going to throw those in the
NVIDIA, yeah.
But even that's having a short-term breakdown and pulling down, into a 50-day.
Yeah, NVIDIA's just now losing its 50-day, and semiconductors have held up, until yesterday. Really, they held up well on a relative basis through all this.
I think you brought up something really important, and that Apple breaking below this 168 level, it's going to be problematic for your cap-weighted indices with that happening. Now, could you see some stocks underneath the surface do just fine over the summer? You could, but when Giannis isn't playing in the playoff game, that's a little bit of a problem.
Yeah.
And
they're not really proving they can win without him right now.
Correct. And if Apple's going to be below 168, that's going to be, I'm with you. I think that makes for a hard summer from a broad indice perspective. I don't think we need to necessarily say things are over for stocks, but man, it makes it hard.
Makes it really hard, and you're losing the other. I mean, I assume now again, Google. Some of these look fine. Are they and right? And so Google looking fine has allowed XLC to look fine on a relative basis. Is it something like, am I buying XLC here now? Probably not. And then you always have to take into context, we talk about XLF financials making new relative, I think 1 year relative highs today for financials. Swift move. I mean, it was pretty nasty 2 weeks ago. Been in this range for a while. Holding its relative 200-day though. Now, the flip side to all this, and we've talked about this before, is, okay, so am I excited about financials, or is this just part of this? Yeah, it's going to outperform to the downside because tech is such a dark cloud.
Well, I think your point.
Russell tried to get it going today.
I think your point is very valid. You're just saying, hey, when we look at how things are weighted, and from an S&P 500 perspective, it's not like financials and even energy can overcome the size of information technology, right? Financials is 13%, energy is 4%. Meanwhile, tech is 30%.
And it masked, and we got the reverse for a lot of 2023, right? Where the tech overweight helped, and it masks a lot of the crap going on that just really wasn't working. And then it kind of really started to work Q4 into Q1. And now we're back to your point, there could be a decent summer for some areas, but are we going to get to August and the S&P is going to be, flat to down? But yeah, I don't know, pick something, gold miners or industrials, they have an okay summer. So I don't know. I wish I did.
We only know what time and price filling in that time. You look at sectors on the year and you have real estate negative on the year. And from a broad perspective, you've got small caps negative on the year and the Dow Jones negative on the year.
Man, isn't that wild to think about?
It is.
It's been a quick 2 or 3 weeks for a lot of indices and stocks.
And the best performer of the year so far is energy, materials, but at the same time, and everything's within context. You don't just get to look at one piece of information and not connect it to another piece of information. My point being materials, XLB. It's the second best performing, or I should say, it's in the top 5 performing sectors. But yet, I think you highlighted last week, we've got a false breakdown potential for XLB. So everything is within context.
And XLF.
Yeah.
I think XLE is the last one. I don't think, XLK. I think XLK is still pretty far away, which we should be for all of the sideways looks going on with these technology charts. It is still overall, it's got the best absolute and relative chart.
Technology,
yes.
It's really hard because you can't sit there and say, oh, yeah, these things are supposed to move in a straight line, and you get caught up in recency bias, right? That bias that the most recent events are how things are going to continue to be. No, market corrections are perfectly normal. We had a great 5 months, November through March, and here we are in April, which from an election year standpoint tends to be flat to down, including May. So do we see a corrective market? I think that's a little more obvious now to say 5+% off the highs using the S&P 500, 7% off the highs using the Nasdaq 100, with the majority of that move being this week. And from a breadth perspective, we're seeing an increase in stocks that are below a 50-day moving average.
We are.
Now, I think it's also important to remember what direction is the 50-day moving average?
It's rising.
Yeah, right. Is it a rising? Is it a flat? Is it a down? Directionally down 50-day moving average. And so here we have for most stocks a rising 50-day moving average, however, an increasing amount that are below that 50-day. So we're below.
It's a little flat. Yeah.
And we have a rising 200-day.
And that's the big one. I'd also say this. I've gone through quite a few. I always go through lots of charts. But a lot of areas, XLK, for example, also coming back into, off the Halloween lows, 38.2% retracements, which David Seta would tell you is a pretty basic correction. And it feels bad, right? Because we went out for when you get 15 green weeks in a row or whatever it was, a basic correction on a big multi-month rally can end up being 5, 6, 7%.
So you're saying for a lot of things that you're looking at, you're seeing what's called a Fibonacci retracement from the highs, like from the, I'm going to call them Reformation lows, Halloween lows, to the all-time highs. That is a move, and then that would be your 100% of the move. And from that, you're seeing what's called a retracement of a 38.2. And I want to be clear to our listeners who might not be familiar with this type of analysis. He's not saying things are 38% off the highs. He's saying of that move, we've pulled back 38.2%, which it's not, I don't want to give it, because some people talk about technical analysis as voodoo or magic, but it is interesting from observing herd behavior, which is what studying price and technical analysis is, how many times we see price move to this 38.2% retracement and pause and move higher. And I think that's what you're highlighting, is you're seeing that across a lot of different things.
If a stock moved 10% and then it corrected 3.82%, that would be very, 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 that's what you would expect, right? We all know stocks don't go up forever. We all know, we got to 15 green weeks in a row, but every week you add on top of that, the chances that it keeps going are slimmer. I don't like to use the word we were due. I don't think that's fair in markets. And it's usually a pretty dangerous way to view markets. I could say we were due a correction at the 7th green week in a row. And we got another 2 months of it. So
everything is contextual, right? For this last investor presentation we did just this last week, the question we posed, is it too far, too fast for this market? Well, time frame matters. Context matters. Are we talking about the past 6 months, or are we talking about the past 3 years? Because, while we've experienced a 5-month move from Reformation and into end of March, that was in the top 1% of moves in veracity. At the same time, we're talking about an S&P 500 on average returns, 8 to 9%, is only 4% return January of 2022, December of 2021. So context matters. Yeah, maybe we've had a really great 5 months and a correction is warranted. Like you said, I don't like using the term due, but from a really big picture perspective, to have a 4% return 2 years and or more than, let's see, just over 2 years. I mean, you're talking about a 2% return for stocks. I don't know if that's too far, too fast.
Here we are. It's April 19th. To your point earlier, I mean, this pretty normal behavior. And yeah, the higher the roller coaster goes, even if it's a practical, retracement, just feels harder. And right, the high beta stuff, it's fun on the way up. It's painful when there's a correction or a sideways move. You just got to realize the pool you're playing in.
What I think is interesting from a behavioral standpoint and the biases we have to deal with, and I don't want to slam biases because they're the thing that keeps us from running a red light or touching a hot stove twice. But from a behavioral standpoint, the expectation that the market would move directionally the same as it had the past 5 months, a little bit unrealistic. And at the same time, that the market would continue to move in the same way it has the past 3 weeks, also unrealistic. And you have to marry those two different pieces and understand the big picture of where the market is at. And could it move lower? Absolutely. Markets get to do what they want. And that can be very hard for people to hear, is the market really doesn't care what you think. It doesn't care what I think. As normal as it is to have a 5 to 7% correction, it can always correct further. But the reason why we use technical analysis at Adaptive is simply because it tells us where the thesis of higher prices is wrong. One might say, well, we don't have higher prices last 3 weeks. Correct. There is such thing as normal volatility in uptrending markets. Where the thesis starts to break down, and this is where I'll pull you in, Ian. For example, for me, one of the things would be if we cannot hold 4,800 on the S&P 500, that would be step one into a thesis of maybe we're heading back into some type of correction. Or are there other things? I think you mentioned equal weight S&P. Are there other things that you're seeing that make you question the thesis of our overall broad market, uptrending market versus, hey, losing these certain price levels, seeing sellers gain more control over this market? These are some things I'm looking at. Is there anything for you that you're looking at in that perspective?
Yeah, I mean, obviously 4,800 is going to be the big one for there. It's more intermediate term. I think 50-50 is a big area. I mean, below this gap, right? These February 22nd this year, these gaps. S&P today is, within the last couple hours, gone through it. Nasdaq was through it yesterday. So these gaps that are been, for the most part, filled. Now the Dow filled its, a week ago. About a week, a little over a week ago. So those gaps, the February 22, February 22nd, because I don't want people to think I'm talking about February 2022.
Oh, got it. Yep.
Intermediate term. And then, I think, kind of the next magnet target is going to be 4,800 because we didn't get a lot of pauses on the way up, and thus on the way down, not a lot of big, bold areas of polarity where there was a lot of reaction. I mean, maybe there were ranges for a couple days, but, we didn't create any right? And that's what happens when you get to blue skies, right? There's no resistance. So you kind of just keep shooting off into the sky. I wish we would have, maybe created some more, like I said, areas of polarity where maybe we spent a week or two carving out, but slicing back through a lot of those. And
maybe that's what we're doing right now, is creating, rather than a couple weeks, a couple months of sideways range,
which would be healthy. I mean, this is still a very strong rally off the October lows. We have talked about for weeks and months the long-term bullish green flags in the market that are still intact. Absolutely nothing about the last 2 weeks changes the fact that we have a strong upward rising 200-day.
Mm-hmm.
Nothing about that changes that. We're still right. Let's not forget about our breadth thrusts. And we talked about this just a few weeks ago we like to talk about how bullish these, pick your Whaley breadth thrust or your however you want to measure it. And then we like to throw out the data of, okay, looking out 6, 9, 12 months, 24 months. And then we get a 5% correction and we're like, oh my God. And it's like, well,
that's such a good point
about what happened like 3 months ago.
Right.
It says that the ensuing 12, 18, 24 months is supposed to be really good.
It doesn't have to be, but the evidence, to your point, after breadth thrust is extremely strong that supports a strongly moving market. What it doesn't promise is the elimination of volatility. But your point is extreme. I think it's a great one is, hey, let's not forget the big picture here, which is we had one of the most historic breadth thrusts we've seen back in October, November of 2023. In addition to that, and you did some work on this, price thrusts that we've seen in quite a long time.
I mean, you're averaging, what was it like, at least for the Russell, every 9 years? So once a decade, none of them marked a major top. I know how you feel if we come back to 4,800. I know your sentiments on what we'll be doing.
Right.
And you'll know quickly, right? But it's a great risk reward area. I guess part of me is like, yeah, if we're going to do this, let's just go back to 4,800. Let's get it over with.
Well, what's interesting, you brought up some retracement levels using Fibonacci math is you look at S&P, because I know you were mentioning technology stocks. If you use S&P and you go from those Reformation lows to the all-time highs, your 38.2% retracement is 48.18, and a 50% retracement, which I know is controversial because some people get really picky about that and think that's not Fibonacci, but I'm going to say it is 46.80, and that's the 200-day moving average.
46.80, and wouldn't we all be antsy?
Yeah,
46.80
would get some people squirming.
Yeah, I can tell you those might be some stressful evenings.
And that's just one of those things where the market, what is this market doing, right? Markets are a future discounting mechanism, and they are a method for having supply and demand interact. So when you see price move lower, what it's trying to do is find demand. So that's where we are right now, is trying to find where is their demand, who is willing to buy. The market moving lower in a normal, we get 3 of these a year, is about proving the buyers that showed up before, are they going to show up again? So you mentioned like where we gapped on February 22 of 2024. Are those buyers that gapped the market at that point for real? And if so, likely to have a price response here. And if not, that's also information. We're going to go find out if people are really willing to buy stocks above the 2021, early 2022 highs. That's really what's going on here is finding where is this equilibrium that you talked about, the polarity between supply and demand. So continue. You were going to...
I was just going to say, I hope we can, I'd like to see us draw, like, if we can slow this correction down to the point where we get 4,800 and the 200-day to line up, which that's probably going to take you into like June.
Yeah, it's going to take you some time.
Because it takes a lot to, the 200-day is an aircraft carrier. It takes a lot to turn it around. So I said earlier that nothing over the last 2 weeks is going to affect what happened over 200 days significantly. And we haven't. We've seen the 200-day continue to move higher. We're still above the 200-day. Like the 200-day is going to continue to go higher mathematically because we're just higher than we were 200 days ago. So when you drop off a number, it's just how a rolling moving average works.
You bring up a great point, because if the 200-day keeps its rate of change, it would be around a 38.2% retracement in June. And 200 days ago, for context, what Ian is talking about is, right, if the 200-day moving average is what it is, it's a moving average, looking back 200 days, 200 trading days, the backside is dropping off, and tomorrow is adding to that calculation. So for context, October 2nd is 200. It's 200 days, 138 bars. So I need to move back a little bit further. So your point, I mean, there's lower prices that are going to be dropping off of here because 200 trading days is July of 2023. And when you look at what the next 3 months of data that's going to be dropping off, you might actually see an acceleration of the 200-day moving average to the high side. So I think that meetup between price and 200-day moving average could be sooner than we think.
Because that's when that correction starts.
Right. Might have sidetracked your thought there by doing that
love
calculation.
It. We also lost the year-to-date anchor VWAP on S&P today. You know, as far as things that, I mean, there's got to be fit. I mean, and it's, markets are going hierarchically fixed and there's nothing to worry about. But
well, and I think this is important to highlight too, that most investors, market participants, many people listening to this will be like, why is this happening? And when I say why is this is being this perfectly normal contextual 5 to 7% pullback. The non-sexy answer that people don't want to hear is more supply than demand, more selling than buying. The frequency of selling is higher than the frequency of buying. Many people want to hear is the fundamental why. Like, oh, Iran is doing this, or Israel is doing that.
Oh gosh,
or inflation is doing this. And this is where I'd like to remind people listening to this, everything is reflected in price. Even the things that you don't know. Like, so while Iran and all that crap is, because let's be honest, everyone listening here, nobody wants war. It's the biggest paradoxes in our life is that war happens, but the majority of people don't want it. That's only one piece of information. There's other things underneath the surface that we don't know, but it's why we study price, because typically we don't know those things until later. And for example, while everyone's focused on equities, I think it's appropriate to focus a little bit on what are we seeing out of credit markets, like triple C credit spreads or junk bonds or treasury bonds, because the thesis that you pointed out before is that how is it that even though junk bonds are correcting, that government bonds are correcting more, meaning the relative strength in junk bonds is prevalent in relationship to treasuries, while some may be thinking, hey, is this corrective market behavior based on Iran? What if it's something else? What if it's credit markets? I don't know. I'm not here to tell the market what to do, but let's not presume that if the narrative of what Iran is doing backs off, that somehow that means good thing for equities, because it could be something completely different underneath the surface that we have no clue about until after price moves.
I have no idea. You know, there's this whole resurgence in inflation, which I get. And of course, people pick X commodity to point to about inflation, but I got a whole bucket of other commodities that look horrible. Nat gas, lumber, soybeans, sugar.
You're just saying that like the inflation narrative, while it may be applicable to things like gold and oil, there's plenty of other commodities that don't look as good.
This is the summer to build a fence. Cotton price. This is the summer if you ever want to start a t-shirt company. It's the summer to do it. There's a lot of commodities that oats. Pretty sure corn looks awful. Yeah, corn is. So you go tell your local corn farmer, wheat farmer about inflation and get back to me about what he says in commodity prices. Now, of course, cocoa, hogs have been real strong.
Well, so, you know, I mean,
that's likely going to be expensive, but
you know, and I remember when the price of eggs was the topic du jour back in like late 2022, early 2023, when everybody was focused on eggs and the price of a dozen eggs. And it's climbed back up a little bit. You know, we're levels we haven't seen since 2015 in the price of eggs. And maybe that's why you don't like quiche. It's the value's not there. Like, it doesn't have to do with all the weird things that are in quiche. It just has to do with it's made with eggs, and maybe the value's not there.
I like eggs. I just don't. Too fancy for me. I'm just not a fancy. I'm not a. Quiche is made with. Is quiche always made with eggs?
That I don't know. I always get nervous when I hear the term always. Like it's really bad to use that term in a marriage. I feel like it's really bad to use that term anywhere. And so I get nervous. My guess would be yes. I'm open to no.
My mother makes an amazing, and now my wife has the recipe, so I get this often. Like an amazing egg casserole.
Mm-hmm.
Egg casserole is so good.
Is it the crust? Is it the butterflake crust of a quiche? Like you don't like it's kind of got that.
It's the interior texture.
Okay.
I don't even know if this had egg. This was like quiche.
I don't know.
Yeah.
The only quiche I've had has been from grandma and in-laws and my own mother at a restaurant. I'm with you. It's a glamorized egg dish. Like, why are we calling it quiche when what we're talking about is an egg casserole with pie base, pie crust, butterfly crust, and some spinach thrown in.
That's what I thought I was getting. My wife liked it.
Remember when the narrative was about the price of eggs? And not all commodities are the same. To your point, yes, are there inflationary relationships and commodities that are signaling that type of behavior? Absolutely. But to your point, not all commodities are the same. Lumber breaking down to new lows. Meanwhile, oil is holding up very well. Gold holding up very well. And maybe the narrative, it'll be one of those things where if gold is higher and clients are familiar, we have a position. If gold is higher, 20, 30% from here, and we have some type of downgrade of US debt because it doesn't outpace junk bonds, will we get to be that surprised that it wasn't about some Iran conflict? It was about US government debt. I don't know. Typically, black swans by definition are unknown.
Yeah.
And it's why we use like anybody who says, oh yeah, this is a black swan event. That's the very opposite definition of a black swan event. A black swan event literally means people don't understand it or know it until it happens.
Yeah.
And so,
and everyone's like, oh yeah, we should have probably thought about that.
Or they have
we probably shouldn't have given out $700,000 mortgages to people with 450 credit scores.
Right. Or you have people that suffer from hindsight bias who say, oh yeah, I knew that was going to happen.
Oh yeah, I knew
it. I just knew it. And so here we are. We have an environment. Markets are within the normal bounds of normal corrective behavior on an annual basis. And what I find fascinating, Ian, is the average return of the S&P 500 is somewhere between 8 and 9% on an annual basis, but it's the least likely outcome, meaning that each year you're not necessarily going to get an 8 or 9%. You're going to get an extreme. Something
I think barely even within 3%, like a spread. Like I think you even rarely get like between 6 and 12.
Right. So you tend to get these extremes that define the average. And then on the flip side, so think about that. Your average return of the S&P 500 is between 8 and 9%. Your average correction per year is around 10%. So let that soak in if you're listening to this. In an uptrend, that is your cost to get return, is you have to deal with your own personal bias of loss aversion, which is that minus 10% feels terrible, but in return, you get a positive 10%, positive 9%. And that's what makes markets awesome.
That's the volatility tax.
Yep. And here we are. The adaptive process is not meant to eliminate all volatility. It's meant to identify when there's a downtrend and when there's an uptrend. Right now, we continue to see an uptrend on a big picture perspective. Yes, we've pulled back 5% could continue to pull back more. That is normal volatility, similar to there is turbulence in a flight. When we get on an airplane and fly somewhere, you're going to get to that destination faster than you could if you drove. You might have a little bit more volatility than you normally see in a car, but that's a perfectly normal aspect of markets is you get these volatile environments. Now, the beauty of technical analysis and studies price is we can see where the thesis of ongoing upward price trajectory is less likely. And we've identified that. We've talked about 4,800. 4,800 is the new 4,180. We have a rising 200-day moving average. It's going to take a lot to get that to go flat and turn back down. We have an average return of the S&P over the last 2 years and 4 months of like 2%. Is the bull market over? The evidence continues to suggest no, but we're open to using technical analysis to identify when that thesis is wrong. So with us coming up towards the end of our time together, Ian, anything else you want to highlight before I end our time together?
Yeah, I think just those intermediate term levels, a longer term for, I guess longer term, but I would like to see equal weight S&P fix itself. So got to get up back above 163, 165. And same with IWM. We got to get back out of this range. It's definitely doable. But yeah, again, and I mean, just thought we were out of the hole, but we've tumbled back in.
Yep. And it doesn't feel comfortable. The likelihood of this being another COVID correction where you get a minus 35% move in 26 days is the least likely scenario, but markets do the least likely scenario more than you think. We're open to that. We have
Maybe
our price
that's the new norm. Maybe those are our bear markets from now on.
Yeah, maybe the volatility is just increased from that perspective. We're open to that. Clients are familiar that in certain models, we've already reduced exposure, and we'll continue to do so if we're breaking some of the levels that we talked about before. It's about adapting to different market environments. But current thesis wise, we view this pullback as normal within the context of an uptrend that obviously can, again, the markets don't care what we think, that can change. We would know that if we're breaking below a 200-day moving average. And so we'll see what the upcoming days and weeks go. I wish I could tell everyone listening to this we knew what that would look like. We don't. The only one that knows that is a good Lord Almighty. And we'll continue to provide updates as we always do in written form on a monthly basis for our clients. We continue to do these podcasts, and you do such a great job. We just had our quarterly investment update that clients can check out. It should be out on YouTube pretty soon. And we had great turnout for that. But Ian, with our time ending in a short time frame here, I just want to highlight the Adaptive Select ETF, which supports this podcast. It's listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Distributed by Quasar Distributors, LLC. With that, Ian, we reached the end of our time. If there's people listening to this that appreciate the information, please share it on your favorite platform or give us a thumbs up or a high rating for whatever you use. That would be much appreciated. Anything else, Ian, before we wrap it up?
So right now, all we have, this is a basic correction that you should see multiple times, even when indices in the year up 20+%. You've likely seen a correction to this degree multiple times. So as of right now, it is a basic common correction in a strong uptrend.
Great job providing a good summary and perspective on the context at hand. So with that, we appreciate everybody listening. Thanks again, Ian.
Have a great weekend, everyone.